Yo, Marks over here. So today I sold a stock, and not any stock. I sold Microsoft. Microsoft's a stock that you want to hold for the long term. There's no real trading around or reason to trade around with that position. It's a position you want to buy and continue to add to that position and not really sell that. So why did I sell my Microsoft position today? And what stock did I buy? And let me know in the comments below if you guys think it was a good move or not. Let's get into this. And keep in mind that none of this is financial advice. This is just some random guy on YouTube drawing some stick figure lines on a chart talking to you guys. And if you haven't already, smashing that like button and subscribing to this channel really helps support this content. And also, if you're interested, feel free to check out my wife's Etsy shop. She makes these great handcrafted beeswax lotion bars that are great for moisturizing your skin and make good holiday gifts. Let's get into this. So Microsoft, why did I sell out of my Microsoft position? It's not a stock that I've been holding for quite some time. It's a newer position relatively that I picked up maybe a month ago or so, but this is a position that I wasn't planning to trade around. I was planning to just add to this stock and keep on accumulating to this stock. So why did I sell out of it? Well, one of the reasons, I recently bought Apple. So I have this Apple stock now. I have this exposure to the FANG stocks. In addition, there's a few things that overlap between Apple and Microsoft. Not a whole lot, but there are a few overlapping things with the two stocks. And they're both massive tech companies. So I have that exposure to big tech. Big tech does trade with each other generally in the sector. So there are a few things that kind of overlap there. That's one thing, but that's not a big enough reason why I would sell Microsoft. I'm perfectly happy to have Microsoft and Apple side by side in my portfolio. There's no reason why I would just kick Microsoft out for that alone. Okay, well, what is the other reason? The other reason has to do with an opportunity that I saw, and I just happened to not have extra cash on hand. And some opportunities don't last for a long time. I mean, some last for a long time. They oftentimes last longer than you think. They oftentimes last either longer than you think or shorter than you think. So sometimes you have to act fast. And with a minimal of information that you have on hand, sometimes you have to just jump the gun. Because you don't always have all the time in the world to think, okay, is this a good investment? Should I invest in this right now? And before you know it, boom, the stock already doubled. For example, that's on the quick end. And on the other end, you buy into stock and then it keeps falling and keeps falling. And you have actually a whole year, a whole 2 years to buy into the stock. For example, most pre-revenue companies, you have plenty of time to jump into that stock. Highly on stock right now is at $18. Yes, maybe in the next 3 months, it goes to $20, $25, $28. However, buying it now at $18 and buying it later maybe at $30 in a year or two, let's say, isn't that big of a deal if you're buying it still for $30. And then when you know that the company is getting actual revenue and it's actually going to go to that price target that you think, like if you have a price target of $100 or even $200 or even more, if the stock again is only at $50 at that point and it's going to go all the way up to that price target, you don't have to be just holding that stock in the interim when the company is just starting to form still. So you need to know when you need to rush into something and when you have some time. And when you have some time, you don't have to jump in all at once. And when you're not jumping into stock all at once, you can just dollar cost average. Take advantage of the dips. Just buy a few more shares here, a few more shares there. So when you have a company for the long haul, for the long term, for example, Palantir. I'm adding to Palantir right now as we speak. I bought about a fourth of my position when it was under $10. But this was a stock, obviously, it would have been good if I bought more there. But I didn't know that much about the stock. And instead of learning all about the stock, I just decided to jump in now a little bit. Just jump in now. Learn a little bit as we go. And while I'm learning about it more, as it dips, I'm buying a few more shares here, a few more shares there, and just adding slowly until I can amass the amount of shares and the position that I want in the future. And this is not something that I need to get done within the next year. I have plenty of time to keep adding and amassing to this position because granted, this is a long-term position. So I don't have to jump in all in right now today because there's a few opportunities at least down the road that's going to come up soon that I actually see. For example, the lockup period. When you have lockup periods for IPO stocks, that's oftentimes a period that you see some selling, significant selling around that time period. So that's a time period where I'm going to be definitely buying some more shares if it gets to a certain price. If it gets to massively undervalued, in my own opinion, I'll do some lump sum buying. But other than that, I'm going to do some dollar cost averaging here and there until I amass my position. And that also kind of offsets some risk too. You're not buying at the peak, you're not buying at the lows, you're just buying consistently throughout. Okay, now I got sidetracked a little bit there, but that's just the concept of whether to go all in at once, right here, right now, or if you have more time. It just depends. It depends what the stock is, depends what the company is, depends what the market is like at the moment. But just analyze and understand that sometimes you have more time than you think, and other times things happen really fast. So with this particular opportunity, this is something that was an event-driven opportunity. So this right here is Salesforce. Salesforce had a massive drop. We were sitting at over $250 per share pretty recently, and then we dropped all the way down to under 220. That's a massive drop. And technically speaking, we have a couple cool things going for us right now. We're at the bottom of this trend line right here. That's one cool thing. The second cool thing is that this was a massive, disgusting gap right here that was screaming, saying, please fill this gap. And this gap was filled. So that was pretty cool. Yesterday, we filled the gap all the way down. This close right here was $216.05. And the lows we made yesterday was $215.63. So boom, we made this right here. How long are we going to be down here? We could be trading down in this channel still. We could be, but this might be an overreaction. What was the cause of this sell-off? There were two main factors. One, the Slack acquisition announcement. They're going to buy Slack for over $27 billion in a total deal for Slack. So that's a pretty big deal. But if you're a believer in the deal and you think it's good for the company, this is an opportunity. And so I really like with this deal, one thing, I love many things about it, but one thing that's pretty interesting is that it gives this consumer element to this company. People know Salesforce in terms of the enterprise, but in terms of you and myself, going to work, using Slack, maybe you use Slack, maybe you don't, but a lot of millennials use Slack, love Slack, and that's giving Salesforce that exposure to this new audience. And when those people go into the companies, make those decisions to implement Salesforce with their company, that's potentially going to be an impacting factor and giving Salesforce an even stronger brand than it already has. So first of all, there's that part of why this went down, the deal. The second thing has to do with their earnings. So their earnings was a blowout. They had a massive earnings. It was amazing. But why did the stock fall? It was the guidance that they gave for 2021. It left investors to want more, and it was a concerning thing with growth. This is actually something that's kind of common with this stock, actually, with this company. They oftentimes, in my opinion, and from what I've seen before, under-promise and over-deliver. I mean, just look at the last earnings right here. They beat earnings here and completely demolish earnings over here and over there. So this is leading to a trend of under-promising and over-delivering, and I think that's exactly what is going to continue to happen. So again, this sell-off for two different reasons. One, but you have to think that this synergy of this acquisition makes sense to you as an investor. It makes sense to me. That doesn't mean I'm right. You might have concerns with this acquisition, and if you don't think it's a good acquisition and a waste of money, then this is something that's more concerning for this company. So that's a big step that you'd have to make to think that this was a good deal. So I think this was a good deal. So I sold my Microsoft position. There's nothing really wrong with this chart right here. It looks like Microsoft wants to break out soon, actually. So I sold Microsoft, bought Salesforce, mainly because I didn't have the extra capital to just implement in Salesforce. And I also mentioned several times in my videos before that Salesforce is going to be like the new Microsoft. It's going to be as big as Microsoft. And so along those lines, when I'm looking at Microsoft stock right here, sitting at $214 right now, by the time that Microsoft gets to maybe $300, I think Salesforce, sitting at $220 right now, is going to get to $400 a share. So what I see in terms of the growth and the opportunity ahead for Salesforce compared to Microsoft, they both have a lot of growth ahead. They both are compelling stocks to own, but Salesforce gives me that edge in terms of where I think Salesforce is going, and is ultimately the reason why I sold Microsoft today and I bought Salesforce. So let me know what you guys just thought about that deal in the comments below, but also in general. And one thing to know, I don't hold bonds. Well, technically I did hold Tesla convertible bonds, but that's the only bonds that I actually held. So instead of that, and it's not really instead, it's kind of instead of putting this money in a bank account and accruing interest there, I have my money in dividend stocks, dividend paying stocks. And I really like dividend stocks. I don't even want to sell my dividend stocks, but these are the stocks that I oftentimes just put my money in. If I don't know where else to put my stocks, I just keep adding to my dividend stocks. So Microsoft was more of a dividend play. And so sometimes I'm moving money out of those dividend plays into some other opportunities that I see, and vice versa. But I never really want to sell my dividend stocks. But if I do see something and some opportunity, I will move capital around as needed. And let me know if you guys want to learn more about my dividend portfolio, why I own dividend stocks, and things like that. But I'm going to end this right here. I hope you guys got some value from this content. And if you haven't already, smash that like button, subscribe to this channel for more content like this, and I'll catch you guys in the next one. If you want to support this channel and get an amazing brokerage, here's my referral link to Etrade. I also included it in the description down below. And Etrade is just an amazing brokerage. I definitely like Robinhood as well, but Etrade is definitely something I feel more comfortable with promoting for newer investors and for experienced investors. It's just a solid platform with a lot of resources. I'm really into Robinhood as well myself, but I know that it's easy to not be as disciplined with Robinhood, so I feel like you gain your discipline with Etrade, with that platform, and then go into Robinhood and knock yourself out.